Hi, and welcome to the second part of accounting for leasing in the lease agreement. So we are on the illustration number 4. In the illustration number 4, there is a company called Tiger, which entered a 5-year contract, a lease agreement with the Brothers Limited on 1st July 2009 on an item of a machinery. The bargain purchase option that the Tiger willing to exercise at the 5th year is 80,000. So what this indicates? This indicates that after the 5 year, they will purchase the asset forever and retain with them. So for them, if we want to do the amortization, the lease term does not matter, but the useful life of the asset matters. So in this case, the useful life is 6 years. So if I want to amortize, I will amortize on 6 years rather than the lease agreement, which is of a 5 year. There is a 5 annual payments of 100,000. The beginning they will be beginning on June 2020. Included within them, a payment is 10,000, representing a payment to the lessor for the insurance and the maintenance of the equipment. Okay, so what they have done in this question, they added up a cost, which is a direct cost, or which is an indirect cost for the insurance and the maintenance of the equipment. So in the prior slides, I tell you if there's any cost which is incurred by the lessee about the insurance or the maintenance of our equipment should not be the part of the asset. The concept is very simple. The concept is that if the cost is a direct cost, like in the last case, we have the legal fees and legal charges, all these things, then yes, it is important. If this cost is not a direct cost, then it will not be a part of anything. It will be just expense out. So this 10,000 will be just expense out after making any payment. So they provide you the interest rate. They provide you the annuity value. So if you have a continuous 10-year or 5-year payment, so what will be the annuity value is 3.6048. They also provide you the present value because we have this bargain 80,000 bargain purchase option, which will need to be discounted after the 5-year, which is available at 12%. So here they pre-calculate. So this bargain value will be multiplied by this value. This 100,000 will be multiplied by this value. Another thing will be the interest payment, and rest will be after we calculate the present values. So they ask you to determine the initial measurement of the lease, the initial measurement of the right of the use. So actually the lease liability plus direct cost is equal to the asset value. And afterwards, they ask you to provide the journal entry for the year ended 2020 at the start. So in this case, the present value for a lease for the 90 years will be discounted at 12%. So the present value of the 5-year lease of 90,000 each are discounted at 12%. This will be the lease value. The bargain purchase already given, the amount is already given, will be this value. So total lease value will be 369,824. However, in this case, there is no direct cost. So since there is no direct cost, so the lease value or the liability value is equal to the asset value, because the right of use of the cost is same like the liability because there is no other direct cost incurred. Moving further, so they ask you, hey, if this is the present value, then what will be the entry system? So we know that at the first, they pay a 90,000 installment. Again, if this is A, this is B, so the C will be A minus B. So all we need to do is to determine the B. A is already given in the question. So B is the interest expense. Interest expense on what? Interest expense on the present value. So the value is given here. The amount of present value is here, 1 second, is 12% interest rate. So we will apply the interest 12% on this value. And we will get 44,379. Remaining is the principal repayment. So total outstanding balance after 1 year is 324,203. Moving further with the entry system. So first of all, we have purchased an asset, or the asset to liability. All are on present value. All will be on the present value because there is no direct cost, so there will be no more furthermore debit or credit difference in the asset value and the liability value. Then there is some service charges they have paid, but we will just deduct it from the cash. So we pay the 10,000 for the maintenance that will be paid via cash, and afterwards this cost will be incurred, will be added up in the profit loss account. And we pay some of the interest expenses, which is the principal amount, which we already do in the schedule and the liability. And this will be the amount that will be the part of the schedule. And the service cost will goes to the profit loss. So you can see any indirect cost which is done here will go to the profit loss account. Now, the question arises where this 61,639 coming from. So of course, first of all, it will be amortization of the asset, which is a present value of the asset, which is 369,825, divided by the useful life of the asset, because in this case, the lessee agreed to purchase the asset after the useful life of the asset, after the lease term of the asset. So in this case, we have a lease term, useful life of a 6 year. So we don't use 5 years, we'll use 6 years as a denominator for amortization. So here will be 6 years, and then you will get this amount of 61,637. So in this case, you need to be a little bit more careful what will be the denominator depending on reading the question. Just like in this question, I read here they have a purchase option, so the denominator will be the useful life rather than the lease term. So this will be the entries for the amortization, for the general entries, for the purchase of the asset, for the payment of the asset, and that's pretty much it from this question. Next is illustration number 5. That is again lease accounting for a lessee. So you can see most of the questions pertaining to this chapter is for the lessee rather than the lessor. So for us, the lessee account really matter how he's writing down the account, and the new changes also is available in the accounts. So this is a company who entered a 10-year contract. This question I solved it before. Here they use, here you need to find down the present value using the appendix manually. So you can see the percentage of the rate even from the solution, and try to solve this question. It's quite similar like the rest of the two before this question. This is a practice question for you. The illustration is given, and there's no difference in this question. The only difference is maybe there's a difference in the direct cost that might incur, because here they do the contract, which is a direct cost, which will definitely change the liability. So liability plus direct cost is equal to asset. So direct cost over here is 5,000. So it will change the asset value by 5,000. So that's the only difference in this question as compared to the prior. I will encourage all of you to do. You can take the interest rate or the present value rate from the solution. No need to see the appendix or something. The reason is very much simple, because technological advancement has gone so much far. Nobody checked the manual rate, and this is not a skill to develop in 2023. If you want to develop something, then do the same question on Excel. That's a pretty that's quite better than this, because Excel will find you the rate. Okay, so I'm skipping this question and leaving this to you. Now we are moving to the lessors. So what happened with the lessors? Okay, accounting standard has changed a lot for the lessee. The International Financial Reporting Standard number 16 has developed a lot, or changed a lot for the lessee. For the lessor, they haven't changed anything. For the lessor, they have still two kind of a lease called operating lease and a financial lease. Financial lease is a lease when all the risk pertaining to the asset has been transferred from the lessor to the lessee. Means ownership, everything, control has been shifted from the lessor to lessee. Another is operating lease. Operating lease is different. In operating lease, the asset has to be come back to the lessor. And it is not a complete shift of the ownership from the lessor to the lessee. So after the lease term is done, the asset has to return back to the lessor. So the entry system for operational lease and the financial lease is different. Another thing is that more or less the entries are same between the lessor and lessee. Whatever the expense for the lessee is a revenue for the lessor. Whatever the liability for the lessee is receivable for the lessor. So these are the few differences that come in between these two, lessor and lessee. I will do one of the questions for the lessor and leave a few illustration for you, because in this question they are taking the same illustration, like illustration number 6 is basically a copy and paste from illustration number 3. What we do for lessee, now we need to do for the lessor. So only the entry system will be changed. Okay, so I will do one question and I will leave the rest for you to solve this illustrations, which is quite similar like the last one. A little bit discussion about the retailer, what the retailer and the manufacturer lessor will do, because actually they do not have the property they build, or they manufacture some product and sell to the lessor, like maybe a car manufacturer company. So for them, because they sell the asset on a very higher price as compared to what they manufacture on. So what is the accounting treatment for that particular part? So number one is we take the example from illustration number 3. We remember we already calculated the outstanding balance here, and here, already calculated, same amount, same schedule, nothing changed. So on this was the interest expense, now it's interest revenue. So this one will be the principal repayment now. It was a principal payment at the time. And the amount received here rather than amount paid. So everything is same, just a change in whatever was payable, now receivable, whatever was expense, now revenue. So the entry system is lease receivable to machine. So here the lessor is giving away the machine. In return, he has a receivables, who is going to pay in next 4 to 5 years. Another end, whenever a monthly installment, annual installment is done, he receives a cash. So here the cash is debit, where it is divided between the interest and the revenue. So interest is receiving this one and revenue is this one. So he's reducing the amount of the principal from the lessee account, which is a receivable. So just a change of accounting entries, amount, schedule, calculation, everything is same. Okay, so I'm skipping the old with the new one. So here they discuss about, hey, lessor has 2 types of lease. One is operating lease, another is financing lease. Financing lease is divided into 2. One is a direct financing lease, another is a dealer or manufacturer lease. So the question what we do now is a direct financing lease, where the asset will be transferred to the lessee. Operating lease is the lease where the asset will come back to the lessor. And because there is no transfer of the ownership in this lease. So financing lease, in the financing lease, once we divide it into direct lease, which we just done, another is a dealer and the manufacturer lease, which is quite interesting. And also this is another addition in the International Accounting Standard number 617. They say, hey, since our car manufacturer is a manufacturer and they can lease out the car. And for example, somebody take Purdue or Myvi or some other cars and they go to the company to lease out the asset. So they are manufacturing it and they are earning a lot of profit in leasing the asset because there's a huge amount of a difference. So actually the company do not directly own the asset, they are manufacturing the asset. So in this case, so there are some questions you can do. Yeah, in this case, what will be the entry system? The entry system for this case will go to, 1 second. Yeah, so entry system in this case will go to the lease. So lease to cost of goods sold. So here, whatever the benefit you will get, you will debiting it to the sales. So any gain on the lease, which is manufacturing cost. So if the manufacturing cost was, for example, 1 million, you are selling this car, leasing this car on 1.5 million. So of course, you will write the lessee from this amount, but this 0.5 million, which is an additional benefit of the gain, will go to the sales. So it will be the part of your sales. not the part of your lease receivable, not the part of your inventory or the asset. So another difference, yeah, that will come is you will not credit the asset. It's more like inventory because this is what you are manufacturing. So if you are manufacturing something and you are leasing it out, that credit will be on inventory rather than on asset because this is your operations. In the operation, you are selling this one. So this is the end of this lease concepts. I hope you will like it. There is illustration number 8 given, which discuss how we deal with the profits whenever a person, a lessor is a manufacturer. This is the end of the today tutorial. I hope you like it. We will see you in the class. Take care. Bye-bye.